Okay, so continuing with our discussion about defined benefit plans, and now we're moving into, so the previous videos were all looking at one individual and how the liability calculation for that one individual would change over time as a result of different scenarios, different activities happening. Now this final piece about the PBO, about the liability, is where we're looking at the defined benefit plan liability for the entire company. So again, before we were looking just at Jessica Farrow and how Jessica Farrow's liability was going to change over time. Now we're going to look at, okay, so if we gathered all of that information for all of the employees that had a defined benefit plan, what the company would then do is be able to say for the entire group of individuals who have a defined benefit plan, all of them, what is the service cost associated with each of them? What is the interest cost associated with each of them? And so on and so forth. So that's where this slide, I'm on slide 19, that's where this slide comes into play, because what we're doing is, again, looking at the entire set of individuals that have a defined benefit plan all together and figuring out what's the impact of all of these changes on the entire liability, not just for one individual, but for all of the individuals that have a defined benefit plan. So in the homework and on an exam, you're going to see a question like this that says, okay, given all of this information, make the journal entry for the defined benefit plan for 2020. And so you would be able to take each of these individual items, service cost, interest cost. In this case, we had a loss and we had retirement benefits paid out to the employees. We could take all of that information, and number one, we can use it to calculate what at the end of the period is the liability related to the defined benefit plan. We'd be able to say, well, if we add service cost, if we add interest cost, if we add a loss, because again, a loss is going to create an increase to our liability. If we're losing, that means our liability is going up. And then subtracting the benefits paid. Whenever we pay out benefits, just like any other liability, whenever we pay for something that we owed, that's going to decrease the value of our liability. If we take all of that, add and subtract it together, we would be able to, number one, indicate that the ending balance of that liability at the end of 2020 is $450 million. But then we could take it a step further and actually make journal entries for each of these things, because in the previous examples that we were going through with Jessica Farrow, we learned how to make journal entries for service cost, interest cost, loss, and retirement benefits paid. We also learned how to make journal entries for prior service cost. It just so happens that in this example, there were no prior service costs. So if you're given an example where there's prior service costs, you can go back to what we did with Jessica Farrow and see that the very simple entry that we made for prior service cost was a debit to prior service cost, other comprehensive income, and a credit to the liability. So again, you can look back at the individual example to see what the journal entry was for each of these items. But let's go ahead and jump into our Excel spreadsheet. So I'm on the final tab, and right now we're focused on the left-hand side. I'll explain what all the arrows and what the like why this is orange, why this is blue. I'll explain all of that a little bit later, but for right now, we're just going to focus on, here's all of the information for our pension benefit obligation, for our liability, and we need to first, again, see that if we just add and subtract all of that together, we get an ending balance of $450 million. But then second, we can take a look at what the journal entry would be to account for all of these different changes in the liability. So first of all, we would say that we had pension expense, and we learned in the previous videos with Jessica Farrow that we report pension expense by taking the service cost and the interest cost together. So you can do two separate entries if you wanted to. You could do pension expense twice to show the two of them, or you can add them together and have one debit to pension expense. It really doesn't matter. So pension expense accounts for the service cost and interest cost. Then we also learned in the previous examples that the way that we account for a loss is by debiting loss, other comprehensive income, And so that loss of 23 million is going to be the debit to other comprehensive income. We know that when we pay out retirement benefits, we use a very special cash account. We learned that in the previous lecture. The very special cash account that we use is called plan assets. That's where this arrow is going to come into play, this red arrow, and I'll explain that in a little bit. But essentially what we're saying here is anytime that we pay out the actual retirement benefits that we owe to these employees, we're not paying that out of our normal operating cash account. We have a fund set aside that we're accumulating cash in for the sole purpose of paying out these retirement benefits. It's earmarked for that purpose. So when we go to make the journal entry for these retirement benefits being paid out, we won't credit cash, because then that would mean it's coming out of our normal operating account. We're going to credit plan assets, but I'll put in parentheses that this is a cash account, right? Just so we have an understanding of what plan assets is. And I'm going to make this negative when I attach it, so that when it comes out as a positive number. So that's just to show that it's a credit in our journal entry. It shouldn't be negative or positive like it is up here in the calculation. But again, plan assets simply being the earmarked cash fund that we use to pay out these retirement benefits. And then the last piece to our journal entry is just to show what the effect on the projected benefit obligation is. So we know that our projected benefit obligation went up by 50 million, and we can see how that plays out in the journal entry. If we take our debits and we subtract our one credit, it gives us a credit of 50 million. And we already see that, right? We went from 400 million to 450 million when we did that quick calculation of adding and subtracting all the items together. And then we see that $50 million play out in our journal entry as well. So here is how we can account for the entire body of individuals that have a defined benefit plan, how the liability has changed for all of those individuals together. We can account for it in this way by looking at each item and then accounting for it in our journal entry. Okay, so that, we're going to come back and forth a little bit with the pension benefit obligation, with the liability side of things. But remember, there are two other components to this that we haven't talked about at length yet. We've mentioned it a little bit, but we're going to now dive deeper into those other two items. So again, the three items are the projected benefit obligation, the liability related to the defined benefit plan, the plan asset account, which is again the funds that we set aside, we earmark for the purpose of paying out these benefits, and then pension expense. So those are the three items. We've at length now talked about the liability side of things. Now we're going to move on to talking about plan assets. So essentially what we've been saying is that plan assets are going to be a fund where the company is required to sort of filter cash into that fund. But the idea is that that cash is not, again, I make the joke about we're not sort of shoving that cash under a mattress. You can see what we're doing with that cash is that we're investing it, right? So when we are setting, as the company, when we're setting aside these funds, we're setting them aside with the purpose of investing so that we can earn a return on those funds. Those accumulated earnings, as well as the accumulated earnings, as well as the cash that the company puts into that fund, would then be used to pay out the benefits that we owe to those employees once they actually retire. So you can think about this think about this in a timeline. If you have a lot of employees that are just starting out, you don't have a lot of people that are sort of in there getting towards their retirement period, you would assume that you don't need to set aside as much cash in this fund at that given time, because you don't have a lot of people that are getting to the point where they actually are going to be retired. Versus if you have a workforce that is nearer to their retirement age, you would want to be setting aside funds, more cash in this account, and hopefully, again, accumulating more earnings by investing those funds, because sooner rather than later, those employees are going to be retired, and you are going to have to start paying them out these benefits that you promised them. So again, the pension plan asset fund is simply going to be a fund that we set aside in order to be able to pay out the benefits that we're promising to these individuals. Just like the projected benefit obligation had a few different scenarios that sort of over time change the balance of what the liability is, the asset balance is also going to change. So in what situations is the plan asset balance going to change? Number one, when we make cash contributions to the fund. So if we make cash contributions to that plan asset fund, what we're essentially saying is that we're sweeping cash from our operating account and putting it in this plan asset account. We would do that again as our employees get closer to their retirement period. We would need to have more funds available to pay out those retirement benefits. So contributions made to the fund is simply putting more cash into that fund, and that's obviously going to increase the balance of our plan asset. The actual return that we see on the plan asset fund. So again, these funds are not being, shoved under a mattress. They're being put into a set of investments. And so the return that we receive on those funds, again, is going to increase the balance of our plan asset fund. Because over time, just like any other investment that we talk about, as you earn a return, it increases the overall value of that investment, of that fund. Now, we pay particular attention to the fact that this says actual return. So we're going to talk about that in a second, but let's keep that in the back of our minds, that actual return is what is going to have an effect on the plan asset account. Okay, and then third, payments that we make to retired employees. So as we said in the previous example, right, if we looked at these retirement benefits paid, we said that the account that those benefits are being paid out of is our plan asset account. So now jumping back to slide 21, if we know that we're paying employees the retirement benefits that we owe them, then that's going to have a decreasing effect on our plan asset fund. We're taking cash out of that plan asset fund, distributing it to the employees. That's going to have a decreasing effect. So you can see that the plan asset side of this is a lot simpler. We're not going to go through complex calculations when it comes to the plan asset side like we did with the projected benefit obligation. It's a little bit more simple of an account to understand. So let's go through this example here, and we'll jump into Excel after we read through it. So again, we are Global Communications, and we have our plan asset fund for our defined benefit pension plan. And what we are able to see is that we contributed cash of $48 million to that plan asset fund. So that's going to increase the plan asset fund. Again, we're just basically sweeping cash out of an operating account and putting it into a plan asset account. Then they also tell us what the beginning balance of that plan asset account was. So at the beginning of the year, it was $300 million, and then we added $48 million to it. Then I'm going to skip the rate of return thing, and I'm going to jump down here to retirement benefits paid. Retirement benefits paid were $38 million, and you'll remember that that number should look familiar because that was what we included as in the projected benefit obligation calculation too, right? We said, again, if I jump to slide 19, we said that we paid out $38 million of the retirement benefits. So not only will our projected benefit obligation, our liability, decrease by $38 million, our plan assets are going to decrease by $38 million as well. Okay, so we understand, we've gone through contributions made, we've gone through the payments that were made to retired people. Now let's talk about the return. You'll see here, starting with this sentence, the expected rate of return on the investment of those assets was 9%, but the actual return in 2020 was 10%. So here's what happens in actuality with these plans, right? We would set an expectation at the beginning of the period for how much we would earn in this plan asset fund. And so that expected return, I'm going to just label it E, that expected return was 9%. Right? And then over time, at the end of the year, what we would be able to see is what the actual return was. Actual return, I'm just going to label as A, was 10%. Okay? So now, why is it important to distinguish between these two? Because when what generally accepted accounting principles tell us is that when we are making the journal entries for these accounts, we use the actual return when we're accounting or making the journal entry for plan assets, and we use the expected return when we are accounting for pension expense. And the way that I try, my handwriting is really terrible there. The way that I try to have students remember this is that E goes with E and A goes with A. So we use actual return for the asset account. We use expected return for the expense account. So over time, as the company is accruing their pension expense, they use what they believe to be the return that they're expecting to get. They make an estimation, they have this expected return, and that's what they use over time to record pension expense. And then at the end of the period, they essentially would use the actual return and compare the two. Now, here's the thing when it comes to this comparison. If you're using the expected return to record pension expense, and I'm going to show you how to do that here in a second, and you're using the actual return to record plan assets, if there is a difference between these two things, then that is going to result in a gain or a loss. Now, in this case, think to yourself, if we expected to get 9%, but we actually got 10%, is that a gain? Did we win or did we lose? If we expected to get 9%, we actually got 10%, we won, which means we're going to show a gain in our accounting records. And again, this is because this is basically like a timing difference. It's not going to, because we're not making these journal entries each month, right, the way that a company actually would in real life, this is going to seem a little bit off. But the idea is in the real world, what companies would be doing is recording this pension expense periodically at that expected rate. And then at the end of the accounting period, at the end of the year, they would show what their actual return was in their plan asset accounts. And then they would compare that to what they had been expecting all along. If their actual return and their expected return were different, then they would show a gain or loss. And again, we're going to show how to do this right now in these journal entries. Okay, so now I'm moving over to the middle part of my Excel spreadsheet. Here is all of the data that was given to us in the problem, right? So we started with a balance of 300 million. We said that the actual return was 30 million, and the way that we got that was by taking our beginning balance times 10%, which was given to us in the problem, and then our expected return, so this is expected return over here in yellow, is going to be our beginning balance times the 9% that was given to us in the problem. So expected return was 27 million, actual return was 30 million, which again we said is going to result in a gain. We said that they made cash contributions of $48 million, and we said that retirement benefits were paid of $38 million. So number one, we can use all of those data points to give us what our ending balance is at the end of the period. At the end of 2020, if we add and subtract up all of that information, our beginning balance plus the actual return plus cash contributions minus the benefits paid, our ending balance of plan assets is $340 million. So that's number one. We can calculate what the ending balance is given all of that information. Number two is we can make journal entries for what effects this had on the plan asset account. So here's where this red arrow is going to come into play. I just said that we're going to make journal entries for the plan asset account, but we already made one of the necessary journal entries. Notice this 38 million that was decreasing our plan asset account because we paid retirement benefits is directly related to this 38 million. So we already, if you see down here, we already made the necessary journal entry to account for the $38 million that was paid out of our plan asset account. So we don't have to make that entry again. We already did it. So for this $38 million here in our plan asset column, notice I made the note. This has already been accounted for on our liability entries. You don't have to do it again. So the only entries that we need to make are going to be related to the return and the cash contributions. So first, we'll tackle the cash contributions just because that's kind of the easiest one to understand. We simply would make a credit to our operating cash account for $48 million. So $48 million is how much we swept out of our cash account, and now that's the amount that we would be putting into our plan asset account. So again, one of the things that's going to be affected is obviously going to be plan assets as well, right? Our plan asset account is going to be increased by the cash contributions, and it's going to be increased by the $30 million actual return. So there's two components of our entry. The last piece of this is going to be to account for the expected return, and then what we said was going to be a gain. Remember, if we thought we were going to get $27 million in our return on assets, but our investments actually gave us a return of $30 million, we win. We have a gain. We got more than we expected. So we first off can say that there is a gain. And that gain, just like the other gains and losses, are going to go to other comprehensive income. The gain is going to be the difference between what we actually got and we expected we were going to get. So if we go back to plan assets, remember when we had a loss on our PBO, when we had a loss on our PBO, that loss went to other comprehensive income. Anytime we have gains and losses in these defined benefit plans, they are going to go to other comprehensive income. Okay, so just like the loss on the liability side went to other comprehensive income, this gain is also going to go to other comprehensive income. And then the last piece to this, if you remember I said in the PowerPoint that our pension expense, the expected return is going to be allocated or accounted for with pension expense. And now this is the piece that's going to look a little bit weird. We typically say that we're never supposed to credit an expense, but we are crediting pension expense in this case because what we're saying here is that although we did have pension expense of $65 million related to this defined benefit plan, what we're saying here is by earning a return on these plan asset funds, we are essentially decreasing the overall expense that our business has for these defined benefit plans. Because we are investing these funds and we are being smart about it, that decreases our overall expense related to the defined benefit plans. That's why we go about recording the pension expense in this way. We credit pension expense because what we are essentially showing is that yes, over time we had pension expense of $65 million because these individuals continued to work for us, continued earning their retirement benefits. But because we were smart with our plan asset fund and we invested it in an appropriate way, that is going to have a decreasing effect on our overall pension expense. So when we look at these two things together, the $65 million debit and the $27 million credit, we look at them together to get sort of the net pension expense that we would have for the 2020 year. So again, that is how we account for the different elements of the plan asset fund. So then we're going to move on to talking about pension expense in the upcoming videos.